In early 2008, I was 61 years old and watching something that made me profoundly uncomfortable. Oaktree had raised significant capital for distressed debt investing, and every instinct told me we were positioned correctly for what was coming. But here's what kept me awake. My own retirement portfolio, built over decades, was about to face the most severe test of my career. I had colleagues, friends my age, who were making decisions in those months that I knew would haunt them for the rest of their lives. They were selling everything in panic. They were moving to cash at the worst possible moment. They were violating principles I'd spent 40 years learning. I didn't just watch the crisis unfold professionally. I lived through it as someone approaching the traditional retirement age, understanding that the decisions made in those 18 months would determine whether the next 20 years would be comfortable or catastrophic. What stopped me from making the same mistakes as my peers wasn't superior intelligence or better information. It was a framework I'd developed over decades, tested through multiple crises, refined through painful lessons. That framework saved my retirement. More importantly, it saved me from panic in every crisis since. If you're over 60 or approaching it, what I'm about to share isn't theory. It's what actually works when everything is falling apart and you don't have time to recover from mistakes. Before I continue, I need to know who I'm talking to. Drop your age and approximate retirement savings in the comments. No judgment, just context. I want to understand where you are so I can help you think about what comes next. And if you're serious about protecting what you've spent a lifetime building, subscribe now. This channel isn't about chasing returns or finding the next hot stock. It's about risk management, cycle awareness, and second-level thinking. The kind of thinking that protects wealth when markets lose their minds. I've been through 7 major market crises. I've seen how people in their 60s respond when their portfolios drop 30 or 40%. Most make catastrophic mistakes. Some don't. The difference isn't luck. Now here's what I'm going to show you. 5 specific strategies that have protected retirement portfolios through every crisis since 1987. These aren't complicated. They don't require sophisticated tools or institutional resources, but they do require something most people struggle with: the ability to act rationally when everyone around you is panicking. The most important insight comes in the final strategy, because it addresses the one thing that destroys more retirement plans than market crashes. Stay with me. Let me start with what most people get wrong about retirement investing after 60. They think it's about preservation. They've been taught that their risk-taking years are over. Every financial advisor tells them to shift into bonds, reduce equity exposure, play it safe. The conventional wisdom is clear: protect what you have, don't try to grow it. But here's what 5 decades of watching markets actually shows. The biggest threat to retirement isn't market volatility, it's running out of money. And the surest way to run out of money is following conventional wisdom about age-based asset allocation without understanding market cycles. This isn't opinion. This is pattern recognition across 7 major market crises, 4 complete economic cycles, and thousands of investor outcomes I've observed. The retirees who thrived weren't the ones who played it safe. They were the ones who understood where they stood in the cycle and positioned accordingly. Not recklessly, not with blind optimism, but with clear-eyed awareness of risk and opportunity. I'm going to break this down into 5 strategies. Each one addresses a specific phase of market cycles and how you should think about positioning when you're over 60. Miss one, and you leave yourself vulnerable. Master all 5, and you'll navigate whatever comes next with confidence. These strategies aren't sequential. They're situational. You need to know which one applies right now, and that requires understanding something most people never learn: how to read where we are in the cycle. The first strategy is the hardest because it requires you to do something that feels completely wrong when you're in your 60s. When everyone is optimistic, when markets have been rising for years, when your friends are bragging about returns, you need to get defensive, not because you're old, because the cycle demands it. I learned this in the most painful way possible. In 1999, I watched people my age, nearing retirement, stay fully invested in technology stocks because they'd been working so well. They'd seen their portfolios double or triple. They felt smart. They felt secure. The conventional wisdom said they should have been reducing risk because of their age, but the market kept rewarding aggression, so they stayed aggressive. Here's what most people do when they're approaching or in retirement during a bull market. They chase performance. They see their neighbors getting rich. They read about incredible returns. They think they can't afford to miss out because they're running out of time to build wealth. It seems logical. It feels necessary, but it's wrong. And here's why. When you're over 60, you don't have the luxury of time to recover from a major drawdown. If your portfolio drops 50% when you're 35, you have decades to rebuild. If it drops 50% when you're 65, you might never recover. Not because the market won't come back, but because you're withdrawing money to live on while it's down. Let me show you this principle in action. From 1995 to early 2000, the Nasdaq rose over 400%. Everyone believed technology was different. The old rules didn't apply. People in their late 50s and early 60s watched their retirement accounts soar. Many delayed retirement to capture more gains. Then, from March 2000 to October 2002, the Nasdaq fell 78%. Technology stocks that had made people feel wealthy evaporated. The investors who understood cycle positioning had started reducing equity exposure in 1999, even though it meant missing some gains. They looked stupid for about 18 months. Then they looked brilliant for the next decade. The investors who stayed aggressive because they were trying to maximize their retirement nest egg lost years of gains and found themselves working longer than planned. At Oaktree, we don't time markets, but we do adjust positioning based on cycle awareness. In the mid-2000s, when credit markets were overheated and everyone was using leverage to chase returns, we raised capital for distressed debt investing and sat on it. We looked foolish. We had cash earning nothing while others showed double-digit returns. Our investors questioned us, but we understood where we were in the cycle. We knew that extreme optimism and easy credit don't last forever. When 2008 came, we deployed that capital into opportunities that generated exceptional returns over the following decade. Now here's the second-level thinking. First-level thinking says you should reduce risk as you age because you have less time to recover from losses. Second-level thinking asks, what kind of risk am I actually reducing? If I move to all bonds when yields are historically low and inflation is rising, am I actually safer? If I sell equities after they've already fallen 30%, have I protected myself or locked in losses? The cycle matters more than your age. Your positioning should reflect where we are in the cycle, adjusted for your age and circumstances. So, what do you actually do? When markets have been rising for years, when valuations are stretched, when everyone is optimistic, you systematically reduce equity exposure regardless of how old you are. If you're 65 and we're in late cycle conditions, you should be more defensive than a 40-year-old in the same conditions. But you should also be more defensive than you'd be at 65 in early cycle conditions. Start by reducing positions that have appreciated significantly. Take profits systematically, not all at once. Move to higher quality holdings with less volatility. Increase cash positions even though cash feels like it's earning nothing. This isn't market timing, it's cycle awareness. You're not predicting when the market will fall. You're acknowledging that after years of gains, the risk-reward ratio has shifted unfavorably. The data tells us something important about defensive positioning. Investors who reduced equity exposure from 90% to 60% during the 1998 to 1999 period missed some upside but protected themselves from catastrophic losses. They didn't need perfect timing, they just needed to recognize that extreme valuations and euphoria don't persist indefinitely. This is second-level thinking in action. Everyone else was asking how much more they could make. These investors were asking what they could afford to lose. But defensive positioning alone isn't enough. Because eventually, markets crash, which brings us to the second strategy, and this one separates those who preserve wealth from those who destroy it. When crisis hits, you must do nothing. This sounds passive. It sounds weak. It goes against every instinct when you're watching your retirement portfolio drop 20, 30, 40%. But it's the most important discipline you can develop. I've seen more retirement plans destroyed by panic selling during crashes than by the crashes themselves. The crash creates the loss on paper. Panic selling makes it permanent. Here's what most people do when markets collapse. They sell. They can't stand watching their accounts shrink daily. They convince themselves they'll get back in when things stabilize. They believe they're being prudent, protecting what they have left. Every financial news channel shows chaos. Every conversation with friends reinforces the fear. It seems rational, it feels necessary, but it's catastrophic. And here's why. By the time you feel compelled to sell, the worst damage is already done. You're not avoiding the crash. You're locking in losses at the worst possible moment. Then you face an impossible decision: when to get back in. Most people never do, or they wait until markets have already recovered substantially. Let me show you this with brutal specificity. In October 2008, the S&P 500 hit its low point, down roughly 50% from its peak. Investors who sold in October or November 2008, thinking they were protecting themselves, locked in catastrophic losses. Many never reinvested. They sat in cash, traumatized, while the market recovered. From March 2009 to March 2013, the S&P 500 more than doubled. The investors who sold missed the entire recovery. They turned a temporary loss into a permanent disaster. Meanwhile, investors who did nothing, who held through the terror, recovered completely and continued building wealth. I remember those months vividly. I was 61, watching people my age make decisions in panic that would haunt them forever. Friends called me, terrified, asking if they should sell everything. The fear was palpable and understandable. But I'd learned something through previous crises. The time to sell is before the crash, not during it. Once you're down 40%, selling doesn't protect you. It destroys you. At Oaktree, we weren't selling in 2008. We were deploying the capital we'd raised precisely for this moment. We were buying when everyone else was selling, not because we were brave, because we understood the cycle. Now here's the second-level insight that most people never grasp. First-level thinking says selling during a crash protects you from further losses. Second-level thinking recognizes that crashes are temporary, but selling is permanent. Markets always recover, always, sometimes quickly, sometimes slowly, but they recover. Your ability to benefit from that recovery depends entirely on whether you stayed invested through the darkness. This is what separates successful retirement outcomes from failures, not intelligence, not market knowledge, emotional discipline during crisis. This principle works, but only if you've positioned properly before the crisis. If you're 100% in equities when you're 65 and markets crash, the psychological pressure to sell becomes overwhelming. This is why the first strategy matters so much. Defensive positioning before crisis gives you the emotional capacity to do nothing during crisis. You've already protected yourself by reducing exposure when times were good. Now you can hold what remains without panic. Consider what this means for someone over 60. You're likely withdrawing money to live on. You're watching your life savings shrink. The pressure is immense. But here's the critical insight. If you've positioned properly before the crisis, you have cash or short-term bonds to fund your living expenses. You don't need to sell equities at the bottom. You can let them recover while living off your defensive positions. This is why defensive positioning and crisis discipline work together. They're not separate strategies. They're two parts of the same framework. This leads to an important question that reveals the third strategy. What do you do when markets have crashed and fear is everywhere? This is where most people who avoided panic selling still make a mistake. They hold, which is correct, but they don't take the next step. The third strategy is this. When crisis creates opportunity, you must be willing to add exposure selectively, not recklessly, not with money you need for living expenses. But if you have cash that you'd positioned defensively before the crisis, this is when you deploy it. I know how this sounds to someone in their 60s. Adding equity exposure during a crisis feels insane. But this is where wealth is built, even in retirement. Here's what most people do during the recovery phase. They stay defensive too long. They've been traumatized by the crash. They've watched their portfolios shrink. Even as markets start recovering, they remain in cash or bonds, waiting for certainty. They want confirmation that the worst is over. They need to feel safe. It seems prudent. It feels responsible, but it's costly. And here's why. By the time you feel certain the crisis is over, markets have already recovered substantially. You've missed the opportunity. The best returns come in the early stages of recovery, when uncertainty is still high. Let me show you the mathematics of this. From March 2009 to December 2009, the S&P 500 rose over 60%. Investors who added exposure in March, April, or May 2009 captured extraordinary returns. But it didn't feel safe. Unemployment was still rising. Banks were still failing. The economic news was terrible. Adding equity exposure required acting against your emotions. Most people in their 60s couldn't do it. They'd been too scared by the crash. They stayed in cash and missed the recovery. The investors who understood cycle positioning recognized that extreme pessimism creates opportunity just as extreme optimism creates danger. At Oaktree, 2008 and 2009 were among our most active deployment periods ever. We'd raised capital specifically for distressed opportunities. When crisis hit, we bought aggressively. Not because we knew when the bottom would come, we didn't. But we knew that high-quality assets were trading at distressed prices. We knew that extreme fear creates mispricing. We knew that the cycle would eventually turn. Our investors who participated in those vintages generated exceptional returns over the following decade, not because we were smarter, because we understood that crisis creates opportunity if you're positioned to take advantage of it. Now here's the insight that changes everything. First-level thinking says adding exposure during crisis is too risky when you're over 60. Second-level thinking recognizes that the greatest risk is being too conservative and running out of money over a 20 or 30-year retirement. If you're 65 and you live to 90, you have a 25-year time horizon. That's long enough to benefit from crisis deployment. The question isn't whether you should take risk. It's what kind of risk and how much. So what do you actually do when markets have fallen significantly, when fear is pervasive, when economic news is terrible? You systematically add equity exposure with a portion of the cash you positioned defensively, not all of it, maybe 25 to 40% of your defensive positions. Move into high-quality companies with strong balance sheets, not speculative stocks. Focus on businesses that will survive and thrive through the cycle. This isn't gambling, it's disciplined opportunism. You're buying quality assets at distressed prices because everyone else is too scared to act. This principle has proven itself repeatedly through history. Investors who deployed capital during the depths of the 2008 crisis, the 2020 COVID crash, the 2011 European debt crisis, all generated substantial returns over the following years. The pattern is consistent. Extreme fear creates opportunity for those disciplined enough to act. Your age doesn't eliminate this opportunity. It just means you need to be more selective about what you buy and how much you deploy. Pay attention to this pattern because it reveals the fourth strategy. You must maintain flexibility throughout retirement. This is where conventional wisdom about age-based asset allocation completely fails. The standard advice is to follow a formula. Subtract your age from 100, and that's your equity percentage. At 65, you should be 35% in equities. At 70, 30%. It's simple, it's mechanical, and it's wrong because it ignores the cycle completely. Your allocation should reflect where we are in the cycle, not just your age. Sometimes being 65 means being 50% in equities because we're early in the cycle. Sometimes it means being 20% because we're late in the cycle. Here's what most people do. They set an allocation based on their age and stick to it regardless of market conditions. They rebalance mechanically. If equities rise and exceed their target allocation, they sell some. If equities fall below their target, they buy some. It seems disciplined, it feels systematic, but it's inflexible. And here's why. Mechanical rebalancing forces you to sell after gains in a bull market and buy after losses in a bear market. That sounds good in theory, but if you're selling equities in 1998 because they've exceeded your target allocation, you miss massive gains in 1999. If you're buying equities in 2008 because they've fallen below your target, you're catching a falling knife. Let me show you how flexibility works in practice. From 2003 to 2007, I watched equity markets rise steadily. Credit was easy. Valuations were expanding. By 2006, I was increasingly defensive even though I was only 59 years old, not because of my age, because of the cycle. I reduced equity exposure gradually, increased cash positions, focused on quality over growth. I looked overly conservative. I missed some gains in 2007, but when 2008 hit, I had flexibility, I had cash to deploy, I had emotional capacity to act because I hadn't been fully exposed to the decline. That flexibility allowed me to add exposure selectively during the crisis, which generated strong returns during the recovery. At Oaktree, our entire investment approach is built on flexibility. We don't have rigid allocation targets. We adjust positioning based on opportunity. When markets are expensive and risky, we hold more cash even if it means missing some upside. When markets are cheap and opportunity is abundant, we deploy aggressively even if it means taking more risk. This approach has worked through multiple cycles because it respects the reality that markets are cyclical, not linear. Your retirement portfolio should work the same way. Now here's what separates those who understand this from those who don't. First-level thinking says maintaining consistent allocation provides discipline and removes emotion from decisions. Second-level thinking recognizes that rigid allocation rules force you to ignore the most important variable, where we are in the cycle. Discipline isn't about following rules mechanically. It's about having a framework that adapts to changing conditions while maintaining core principles. This is second-level thinking in action. Everyone else is following age-based formulas without thinking. You're asking what the cycle demands right now and adjusting accordingly. You're maintaining flexibility to be defensive when markets are expensive and opportunistic when markets are cheap. This is what keeps you wealthy through multiple cycles and decades of retirement. This next part is crucial because it addresses the mistake that destroys more retirement plans than any market crash. You must protect against the one risk that conventional wisdom completely ignores. Everyone focuses on market risk. They worry about crashes, volatility, losses. But the greatest risk to retirement isn't market volatility, it's inflation. And the fifth strategy is building a portfolio that can survive and thrive through inflationary periods because inflation is the silent killer of retirement portfolios. Here's what most people do. They move heavily into bonds as they age because bonds feel safe. They provide steady income. They don't have the volatility of stocks. Every conventional retirement plan emphasizes bonds for stability. It seems prudent, it feels conservative, but it's dangerous. And here's why. Bonds get destroyed by inflation. If you're holding bonds yielding 3% and inflation is 5%, you're losing purchasing power every year. Over a 20-year retirement, that erosion is catastrophic. You might preserve your nominal wealth, but your real wealth, your purchasing power, steadily declines until you can't afford the life you planned. Let me show you the mathematics that most people never consider. If you retire at 65 with $1 million and inflation averages 3% annually, you need your portfolio to grow to over $1.8 million by age 85 just to maintain the same purchasing power. If you're heavily in bonds yielding 2 to 3%, you're not growing fast enough to keep up with inflation, especially after taxes and living expenses. You're slowly going broke in the safest way possible. This is the hidden danger that conventional wisdom creates. It protects you from market volatility while exposing you to purchasing power erosion. I learned this lesson early in my career during the 1970s and early 1980s. Inflation reached double digits. Bonds were catastrophic investments. The investors who preserved wealth held equities and real assets that could grow with inflation. They endured volatility but maintained purchasing power. The investors who followed conventional wisdom and held bonds saw their retirement plans destroyed by inflation, not dramatically, not visibly, but steadily and inevitably. This is what time frame of experience teaches. Inflation risk is more dangerous than market risk for long-term retirement planning. At Oaktree, we've always maintained that the greatest risk isn't volatility, it's permanent loss of capital. And inflation causes permanent loss of purchasing power. This is why our approach to retirement investing emphasizes maintaining equity exposure throughout retirement, adjusted for cycle positioning. Not because equities are always the best investment, but because over long periods, they're the only asset class that reliably outpaces inflation. Your retirement portfolio needs this inflation protection. Now here's the final insight that ties everything together. First-level thinking says bonds are safe for retirees because they're stable and provide income. Second-level thinking recognizes that the definition of safety depends on your time horizon and the biggest threat you face. If you're over 60 and you might live another 30 years, inflation is a bigger threat than market volatility. Safety means maintaining purchasing power, not avoiding volatility. So what do you actually do? Maintain meaningful equity exposure throughout retirement, adjusted for cycle positioning. If we're early in the cycle, maybe 50 to 60% equities even at age 70. If we're late in the cycle, maybe 30 to 40%. Include real assets that benefit from inflation. Real estate, commodities, inflation-protected securities. Don't follow age-based formulas that push you heavily into bonds just because you're over 60. Think about the cycle, think about inflation, think about maintaining purchasing power over decades. This is what 5 decades of investing teaches you. This is what surviving 7 crises shows you. This is what protecting retirement wealth proves. Crisis strategies for those over 60 aren't about avoiding risk. They're about understanding which risks matter and positioning accordingly. Get defensive when markets are expensive. Do nothing when crisis hits. Add exposure when opportunity emerges. Maintain flexibility throughout. Protect against inflation always. These 5 strategies work together. They're not separate tactics. They're an integrated framework for navigating retirement through multiple market cycles. I've spent 50 years learning this. I've made mistakes. I've watched others make worse mistakes. I've refined these strategies through 7 major crises. You now know what took me decades to learn. You have the framework. The question is, will you use it? Because here's the reality. Most people will read this, nod along, and change nothing. They'll follow conventional wisdom. They'll make age-based allocation decisions without considering the cycle. They'll panic during the next crisis. They'll get the same results everyone else gets. Don't be most people. Drop a comment right now with your age and one specific action you're going to take based on these strategies. Public commitment increases follow through. Use it and subscribe if you haven't already, because this channel is about thinking differently when you're over 60, not following formulas, understanding principles. This is about making the next 20 or 30 years of your life financially secure regardless of what markets do. Market cycles will continue, crises will happen, inflation will return. These are certainties. Your ability to navigate them determines whether your retirement is comfortable or compromised. I can't do it for you. I can only show you the framework that's worked through every crisis I've experienced. The rest is up to you.